Good morning, everyone. I would probably assume that many of you have not had the experience of dealing with a collection agency. So what I'd like to do is just explain to you very briefly before I get started, is just that the collection process is something that is quite indignant at times. And unfortunately, or fortunately, however it looks, when a consumer receives a phone call from us, they do not have our picture on their refrigerator, nor are they anticipating and can't wait to the fact that they're going to hear from one of my agents. So what we have done in the last 3.5 years is really kind of take a look at the collection industry and the collection process and kind of turn it upside down. So today I'd like to explain to you some of the differences in the whys, as Peter mentioned, as to what our business does and how we actually work and operate, and some of the actual working philosophies that we actually have. In some cases, I guess, as any other business, you go through motions, you go through processes in order to develop and improve the business. And I think that the last 3 years have been a testimony to that. Changes in technology, changes in leadership, and very excited to present to you today. I myself have been in the industry for around 30 years. Been in collections. I started at the desk, so as those old generals used to speak and talk about what happened on the battlefront and what happened at whatever battle it might be, I can actually be a good testimonial to how collections has changed far across. The Royal Commission has had impact in the actual ways that people are actually treated, and from my side, from my perspective, I think that we've done a good job around that. My previous position, as mentioned, was Australian Receivables Limited, was a major a subsidiary for NCO Financial, which was EGS, had about 150,000 employees across the world. And I'm very delighted to be here as my 3.3 years with Collection House has continued. The disclaimer, please feel free to read this online at your leisure. It's the same that we had in our fiscal year 19 results presentation. We have a good functioning, highly qualified board with a mixture of experience and gender diversity. And our senior management team is clearly well qualified and have been appointed or promoted in recent years. With the appointment of Doug McAlpine, our CFO, a couple of months ago, I'm confident we have a complete and exceptional team to take us forward. The share price has reflected our performance over the last year, which has actually been quite flat. And I'm actually pleased to see a pickup in the price since the fiscal year 19 results, reflecting our optimism that we may finally have turned the ship around with fiscal year 20 looking much more improved. Collection House was founded in 1981, has been listed on the ASX for around 19 years. With over 850 staff, we are the second largest debt collection company in Australia and work with banks, utilities, corporates, and Australian government departments. We operate as principal, where we buy outstanding debt portfolios from our clients, and as agent, where we earn a free fee to manage the debtor on behalf of the client. So in other words, we have two segments. The first segment being the one which we actually go out and purchase accounts from banks and financial institutions, which we place on a balance sheet, which is our Lion Finance Group. And on the other side, our collection services front, where we obtain a commission or we obtain a per-seat stipend for actually working their portfolios. In the last 2 years, we have grown our book of receivables by over 50%. Two-thirds of the business is buying PDLs, and certainly our growth in the coming years will be from the principal business rather than the agency work. We buy portfolio debts from clients, and their own internal debt recovery process has been exhausted. And we actually use our experience in analytics to actually price these assets. In fact, I brought in one of my senior leaders from Encore Financial, the world's largest debt buyer. He was actually one of the group in the founding team, and brought him as a chief data scientist to help us assess books and portfolios across Australia and New Zealand. We assess the customer's financial situation. We work out a sensible repayment plan with them. Many times people can't afford the payment plan. There are options that we have to take, including the fact that in some cases we may forgive the debt because the consumer has such significant emotional events that would not be justifiable for us to actually continue the collection process. Debt collection is difficult and often emotional, but nevertheless an essential process in a functioning of a capitalist society. We are proud of our track record helping consumers out in financial difficulties. And basically, I think if you want to know the average payment time arrangement, it's probably around 4.7 years, where a consumer would have an opportunity to pay. And as the customer situation improves, we have an opportunity for the consumer to either go ahead and pay the bound in full, and in some cases negotiate a settlement which will benefit their situation altogether. And overall, from the purchasing side of the business, we are actually looking at trying to get around a 2.4 times return on our investment. On fiscal 19 performance, more or less, the revenue, 161 million, was up 12% the last year, including our second PEP transaction with Valbec Capital, which provided a useful source of capital. PEP is basically a portfolio enhancement program where I take accounts that have actually, for all practical purposes, paid for themselves over an extended period of time under an arrangement. So basically, I take those accounts and I would sell those to Valbec Capital and receive the cash up front and have the ability to work those accounts on their behalf for 5 years. And that cash up front, which is unencumbered, in some cases, I think the last 2 years, we've had about 19.5 and 25 million of cash. We have taken that cash and we have reinvested it, in some cases within a couple of weeks, to purchase portfolios from banks and experiencing and basically would experience a higher return in the future. On the actual earnings per share information that we have listed, we have noted that the 15.8 cents excluding PEP is based on the numbers that we would have we strip off the one-off profit from the PEP program for more clarity. And the actual PDL purchases last year, we were at $133 million, up 63% on fiscal year 18. A lot of that was two things. Number one, we had the ability to purchase more accounts due to AASB 9 and the reduction of balance sheet accounts that the banks had. We had more opportunities to purchase. And secondly, we had two large acquisitions last year, one in New Zealand with RML, and the second was a company out of Sydney. And those were approximately around $60 million of the total amount. Just to note, about 97 million of the 133 million was done after April of last year. And a lot of that was related to the fact that banks had some delays in selling due to the Royal Commission in reviewing of accounts. And guidance for fiscal year 21 is strong for cash collections. Since we have purchased and we have made some record purchases, we will experience a higher amount of collections this year, and that cash collection component is going to raise from between 145 and 155 million. What do we stand for? And this is probably some of the background, as I mentioned to you earlier, about the collection process being indignant. We are a good corporate citizen. We have been a first mover in comprehensive credit reporting. For those who may not be aware of what comprehensive credit reporting is all about, it gives you an opportunity. In the old bureau method, you would have defaults only listed. But in comprehensive credit reporting, the default's still there. But the fact is, you also have an opportunity for each and every month you make a payment for a comprehensively reporting company. You have an ability to increase your score as the actual payments come in. The ticks show and provide the opportunity for the consumer to build their score with good payment history. And we are one of the first movers in our industry in that area. And also, we've made some big inroads in the financial hardship program. We were actually one of the founders of the Financial Hardship Registry through the ACDBA, which is the Association for Debt Buyers here in Australia. We're a financial innovator. The innovation is so important to try to get customers to actually communicate with us. And we've done that quite strategically with the opportunity to use our third parties, which in some cases we would find opportunities to sell accounts to third parties who may not have the full licensing ability to purchase. And then in addition to that, to recycle that capital by actually selling those accounts at a higher amount than on our book face value. And then secondly, providing them services and products and receiving products from them as well through our portals. And then from them, also opportunities with skip tracing and other products that they may offer. We're a believer in the power of technological disruption. Our online portal and our call center technology is driving up customer engagement and cash collections while driving down our costs. And a big opportunity around the actual portal is, I think probably simply put, it gives the consumer an opportunity to contact us and speak with us without even having to pick up the phone and reach out. We're a challenger to the status quo. We have changed both capital funding and customer interaction. The next step is to offer our consumers more products and services. Our social license to operate, our industry has transformed from debt collection more to financial rehabilitation, with comprehensive credit reporting and the opportunity for a consumer not to have that 6-year to 7-year note showing up as a default. If they go ahead and actually pay through the account and pay it off in payments to a certain limit, and then the actual account shows as a paid in full, they have an opportunity to get their credit situation more in line in a quicker manner. We try to engender a culture of sensitivity. It is important that we listen to consumers, but then the portal gives us an opportunity actually to give the consumer an opportunity to work with us without even having to pick up the phone to speak to an agent. We have extensive technologies and procedures in place to try to ensure we operate in high standards of customer care. It's all about taking that view if a customer is facing a significant emotional event to do the right thing by that consumer. And some of our new technology that's emerging through our AI systems will provide us even added bonuses to be able to detect emotion from consumers when they're having a conversation with us. We're willing to assert our rights where customers have an ability to repay, but we invest in programs and customers that have fallen into hardship. So as we mentioned, the hardship registry, but in addition to that, dealing with groups and associations to help educate consumers, educate children around debt and responsibilities around debt, to give opportunity for our consumers to understand comprehensive credit reporting and the importance to actually have an opportunity to improve their situation without having to worry having that ball and chain, if you will, for the next 6 years. Now, in reference to some of the financial analysis, I think it's quite important for you guys to know one thing here. From our end, we've tried to show the strong correlation between expenditure for future cash collections. And as you'll see in the labels on the x-axis on the bottom chart, the one delayed from the chart on the top, this is to show the correlation lags between 12 and 18 months, but it is pretty consistent. In fiscal 19, we invested heavily due to the availability of financing from our banks, our own cash flows in the portfolio enhancement program. This larger level investment will flow through the future cash collections, profits, and dividends. In the first 2 months of the financial year, we've seen a meaningful uplift in cash collections rate. In fact, we're actually looking at, from our fiscal year 19 end of year report, we're actually looking at a run rate of about 130 million, which is actually significant from the comparative recent past. And that growth is going to continue based upon the purchases we made in April and the momentum that we're actually building, as we see here in the graph. We, the technology adopters, very much in detail that we believe that technology can be harnessed to reduce costs and improve customer experience, like many companies here probably can profess. We have invested significantly in our own client platform, which is called C5. And that client platform we use across not only our Lion Finance business, but as we work with with companies and banks, we get them onto our system and enable them to use our system in place or in conjunction with their existing systems that they have. So it's a great advantage for a bank or financial institution to have us help them with their technology and drive the actual performance that's required. We have developed an online service portal for customers to schedule their own repayments, maintain hardship applications, and reach out to our resolutions team. So this is not just a typical portal where you make your payment only. This is a full suite of products where a customer can actually interact with us. And we use social networking boxes to give the customer an opportunity to explain their situation. In addition to that, to post documents up to tell us about their situation and what's happened. And some really meaningful statistics that come out of this is that 40% of the consumers in the last 15 months, 40% of the consumers that have used it that did not contact us in the past found the portal quite useful and were able to actually resolve their account. 8% of our revenue now, 8% of our revenue from Lion Finance is actually being derived from this self-service portal. And as you guys can probably appreciate, there's almost no running costs and now represents that 8% of collections on the Lion Finance side. And on the other side of the business, we have about 12 to 15 iterations of white labeling for different clients for them to use this type of portal service. It's also being used from a global perspective. We have some clients from the US also using it, and it's been quite useful for them, and it's definitely an opportunity for us to continue growing our technological expertise and driving a way to actually get consumers to respond to us, and keeping in mind the opportunities around comprehensive credit reporting to drive a reason why they should actually try to resolve their situation. But it's very important to know that, as we know with this technology, when people do reach out to us with a hardship situation or another financial difficulty issue, we're able to actually communicate with that consumer via phone and interact with them on a personalized basis if required. In fiscal year 20, year ahead, as I mentioned earlier, the strong upturn of purchases will now justify 145 to 155 million of cash collections. So one of the big opportunities for us, if you look at historical numbers of being somewhere between 107 to 114, you're looking at 30 to 39% growth on fiscal year 19. In PDL purchasing outlook, the actual market continues to offer ample opportunity to deploy capital in Australia and New Zealand. New Zealand, because of our acquisition in RML, we have some great relationships there, as well as the old relationships we have. We know that the Reserve Bank in New Zealand is actually calling for banks to reduce what's on their balance sheet. And for the last 4 to 5 years, banks have not been selling in New Zealand. So we do see that as changing. We do consider that as a big opportunity for us. As we saw with comprehensive credit reporting earlier, it is going to give us an opportunity to be able to have more effective purchases in that market. Our purchase guidance is 80 to 100 million versus the 133 million we had last year. Now that's barring no other acquisitions or other opportunities, but we're always having a keen eye to that because we know there's further consolidation happening in the market. PDL pricing remains stable and favorable, with the risk more to the upside of improving prices. And on the collection services division, we know that the improvement has been seen now after a year of disruption by the Banking Royal Commission. I think we've seen about a 9% improvement versus 2019 to date. And we know that the expansion in New Zealand is going to be useful there, and some opportunities that are actually starting to emerge. And post-year trading definitely has improved. And we will be providing APS guidance along with impact guidance, indoor and impact guidance at the AGM on the 1st of November. So in short, it's definitely a big opportunity for us. We're very, very excited about fiscal year 20 and the prospects of using our technology to drive better performance. In addition to that, understanding the relevance and usefulness of our industry. And hopefully you guys have an impression of collections now that might be a bit different. Thank you.
Are there any questions of Anthony?
Last year you had, I believe, bankruptcy actions, 512 of them against your customers, and your major competitor had 0. Is that having an impact on your ability to purchase books from banks and other people?
That's a good question. One of the things about the 512, and I'll probably explain this from two fronts. Number one, we're one of the only end-to-end servicers across Australia where we have our own legal offices and legal facilities. And one of the things that we do in our legal processes across the business is if a consumer goes into some type of legal process where they've been served, the only way that would actually happen is one of two things. Number one, if they had a high ability to pay that we've been able to reflect off of data and data review, but then a low willingness. A low willingness meaning the fact that we have not heard from that consumer, we have not been able to contact them. They basically have refused to actually engage with us. And during any process of that time, a consumer would have the ability to actually flag up and raise their hand and say, hey, listen, I need some help here because I'm not going to be able to pay. And we remove them from the legal process. So I want to make sure that everyone understands that the legal process is not somewhere that you're going to be stuck in and the door closes. It's an opportunity for us to try to engage because we have not been able to engage with said person during that period of time. Now, from our end, the process of going through and having conversations with institutions and companies was one that we did post the actual 730 report. And, I know that the social feeling around this, albeit the fact that we have about 479,000 accounts and 512 that went to bankruptcy, it was noted in the 730 report as well that we did not in any way, shape, or form finalize the bankruptcies with those two consumers. In fact, they were settled. The accounts were settled before that. And it just goes to a testimonial to our process that we do not wish to have the legal result to the end, and we don't drag anyone to the court. It's a matter of basically trying to get them to interact with us. And that's a very, very prime and important consideration. As for the banks, we went through reviews with the banks. In fact, we even took the additional initiative to reach out to the regulatory agencies as well. Our history has always been, we've always been above, in the last couple of years, the actual above the range of the minimum amount of $5,000. In fact, before the report came out, we had already started to implement a $10,000 level. Prior to that was $7,500. Now our level is $20,000, and with the conversations we've had, the banks and financial institutions, they're quite satisfied with that. In many cases, one has actually adopted it. Because they thought that was wise and helpful. And the actual impact economically is not going to be that significant because keep in mind, the judgment has already been filed. And for those who may not be aware, once you actually file for a judgment, you have up to, in some cases, 15 years in Victoria, up to 11 or 12 years in other states. So we have an option to actually consider another way forward. As for the other companies and other institutions, I can't speak for them. Except for the fact that some of them have other tools and services that they may offer. We have chosen not to get into a high interest loan of 47% to actually bring any customers on or attract anybody around high interest loans because we don't find that as valuable. So from our methods, our intention is to actually get the customer to respond to us. And in some cases, that's what occurs. But then it goes further and further at times where it goes to an actual bankruptcy filing. And unfortunately, in some cases, we've done that because we haven't been able to speak with the consumer. So I hope that answers your question.
Hi, I'm just interested in how early you interact with the banks in terms of potential customers' books moving to you. And given that you provide such a strong service in helping rehabilitate financially, have you investigated using that service as a third party to the banks for early identified customers who look like they're heading into an issue and might need some guidance early to deal with that?
We do that with some groups. In some cases, we do that with councils and other institutions on the government side. We have a training division that helps us with that. On the banking side, we're one of the first people to go around and speak with the banks to talk about comprehensive credit reporting and about AASB 9 and the changes. And I remember back early 2017, in speaking with a few folks, they were kind of chuckling about it and saying, well, we haven't heard much about this yet. Let's wait and see. And we don't know if comprehensive credit reporting is going to pass. But we were very, very ambitious to ensure that we communicated to our different consumer bases, but then had an ability to work with some other financial companies and groups to help them understand it a bit. But yes, indeed, we have offered those services in some cases on our contingency arm and a contingency front. We do that on behalf of them. Because we're actually going through the process with the consumer. If they're having a significant emotional event, we're obligated, and we even before we're obligated, we go ahead and contact the bank and let them know that there is a situation that's occurring, and we want to help and assist them as much as possible. So yes, indeed, part of it.
Your competitors moving into the US quite aggressively. Is that something that you've considered, or are you purely domestically focused?
Well, we're focused New Zealand and Australia at the time, and we have our offshore center in Manila. We find that right now is an area that we're focusing on at the moment.
Just got one last question, just in the middle.
Yes.
Just want to check, understand, roughly on average, what type of percentage do you buy the debt from the banks? And you mentioned that you try to get a 2.4 time return.
Mm-hmm.
That's on average. Is that correct?
Yes.
Yeah. Okay.
Yeah. So you can get anywhere from a nickel, it can go up to 35 cents. It depends upon the type of paper, the quality of paper. If it's already a qualified arrangement, then, that would actually bear a higher price if it's already a direct debit enabled arrangement. But it all goes into the analysis from the data analytics side for them to identify which accounts are an opportunity. And the collection process is a 10-year window. So that gives the opportunity for us to be able to generate that revenue through arrangements. As we talked about earlier, 4.7 years is around that average time frame that we're seeing for the arrangement time front. But some cases where customers need more time, we give them that additional time to help them out. But we also contact the customer, and this is something that we agree with the customer every 90 days, check in to see how they're going. And in some cases, that may be just a portal engagement that the customer makes with us to give us an update on their financial situation.